Over the last week, the S&P 500 has looked very strong, especially when we take a look at the Magnificent Seven. In fact, on a fear and greed index, we can see market sentiment moving from neutral territory into greed, which is in anticipation of the rate cuts that we will hear from the Fed over the next few days. And in today's episode, we are focusing on Amazon, a company that we do believe you should seriously consider adding into the portfolio. Now, over the last 10 years, this is over 1,000% in terms of return, and whilst we do see it trade towards the upper end of the 52-week range, we still believe Amazon is undervalued. Now, we notice a strong buy rating from Wall Street. We also see a buy rating from Seeking Alpha, and we do very commonly get that hold from Quant. Now, they don't currently pay a dividend, but this is something we could see over the next year to follow in line with some of the new dividend payers that we have seen, notably both Alphabet as well as Meta over the more recent period. Now, some news that has just come out over the last few hours is in fact that Intel have agreed with Apple to build some custom AI chips, and this is a massive partnership and something that if you are an Nvidia shareholder that we have covered before, that this looks like some very good news. In fact, not just for Amazon, but also for Intel. And as we can see, this is a multi-billion-dollar framework, and ultimately the latest technology is something they're going to be looking at building, which will help drive Amazon's move into the new AI revolution. And what I found very interesting, maybe something that you don't hear a lot, but Amazon have agreed a new deal effectively to advance their warehouse automation. For those that don't know what this is, they have been using a lot of robotics to essentially help with the processing of sale of their products within their warehouses, and why we believe this is a very good move for the company overall, as we are about to show you one area that this company does lack in are those margins, and this will help increase those margins, improving the profitability of the overall company. Now, when we do look at companies, whether it's Amazon or any others, we need to consider both the bullish scenario as well as the bearish, and we can take a quick look. Now, this article was from Morningstar after the release of their latest earnings. So a few areas that they do believe is very bullish for this company moving into the next few years. As we can see, they do talk about Amazon being a clear leader in e-commerce, and they don't believe this is going to change, at least for the shorter term. So one area that they can continue to capitalize on. We also see they have very high margins in terms of their advertising stream, which we will show that very shortly. And also AWS is growing very fast. In fact, one of the fastest growing in terms of this industry as a whole. And finally, they talk about Amazon Prime membership, which helps retain their customers and spend more money within the Amazon ecosystem. Now, looking towards the bearish scenarios, something that they pick up that we have in fact seen with Alphabet not too long ago is the regulatory issues with large technology firms, and they also include under that umbrella Amazon, something that they need to consider, especially if they are looking to continue that expansion internationally. And there are some other companies that you could argue are doing very well, so it's whether or not Amazon can penetrate those specific markets. We can also see the issues of new investments ultimately affecting their free cash flow growth, as we will come to show you. It hasn't been the greatest over the last few years, but this is something we do believe we will see start to accelerate, especially over the next few years. And they talk about it being harder to penetrate other countries due to the fact that they do have some very strong networks within the US, something that they will need to replicate for whichever other countries they do look to start to move into. And they do talk here about the final point in terms of competition, with consumers potentially having a lot more options than just Amazon in the future. Now, the final article that we can touch upon, it is from the Motley Fool, and they talk about 3 reasons that you should be buying Amazon. Again, fairly recent, just from a few days ago, and pretty much the same points that we just talked about. The one key thing here is that they do see this company trading at a low valuation, and this is something we're going to look at when we run this company through our valuation model. Again, just to reiterate that Amazon isn't just an online company. Maybe you think about it and you think all of their revenue does come from that, but what we can see, whilst that is the largest driver of their top line, $55 billion in Q1 of 2024. We can also see from what we mentioned, both AWS and advertising that have been increasing at a fast rate. We do see these taking over at least the second place in the not too distant future. So lots of opportunities. Will be interesting to see if their margins are able to be increased due to this new deal that they have signed, as well as what the future holds with Amazon moving forwards with these new AI chips and what they plan to do for them. Now, in terms of the actual numbers of this company, we want to point out why we really like this. The first thing to note, over the last 4 quarters, now this is a comparison against management targets as well as analysts. They've not only beaten, but we do note very impressive beats. The more recent quarter of Q2, 24 cents, and in fact, even more impressively, over the next 3 quarters, they're anticipating double-digit growth to the earnings per share. Ultimately, if they do hit the next year full EPS estimate, the forward PE will come down to a more reasonable 31.92. Now, we also want to point out this does trade at a premium against the sector, but you could argue it is worth it. In terms of their revenue on a year-on-year perspective, 12.32%, the sector as a whole, low single digit of 1.91%, revenue moving forwards, again, double digit anticipated of 11%, sector as a whole though, low single digit of 3.61%, and one of the things we do quite like to point out is the earnings per share over the next 3 to 5 years on a year-on-year basis, 23%, sector as a whole 10.4%. So we can already see, yes, it does trade at a rich valuation, especially in comparison to the sector, but you could argue it is warranted. Question remains, what sort of premium should we be paying? In terms of profitability, again, another reason why this company does deserve that premium valuation. 48% in terms of the gross profit margin, 37% in terms of the sector median, and bottom line, as we can see, 7.35 versus the 4.55 of the sector median. Interesting though, this is one of the companies, if not one of the top in the Magnificent Seven, that has the largest cash from operations, $108 billion over the last year, again, sector median, $278. So clearly, both on the growth aspect and profitability, Amazon does look historically very, very strong. We also want to point out how do they compare against competitors over the last 12 months as well as the last 10 years. Again, in the broadline retail, we have Alibaba, we have Mercado Libre, a very big one that a lot of people do like on this channel. And over the last 12 months, well, Amazon is up 34%, in fact, the second best out of these competitors. Over the last 5 years, we can see, again, very strong in the middle, but nonetheless 108%. Over the last 10 years, the second best, Just Amelie, up 1,063%. Do remember, whilst past performance is an indicator of the future, we do believe in terms of the investments they are putting into the business, the projections, as well as the more recent quarters, Amazon will, in our opinion, continue to outperform the S&P, as we are about to show you they have done historically. So over the last 12 months, 32% Amazon is up, S&P around 26%. When we look over the last 5 years, again, a very similar story, 105 versus 88. And over the last 10 years, significant outperformance. As always though, important to understand, if you don't have that faith in any company you invest in, that it will be able to outperform the S&P, you may as well just invest in a low-cost ETF, which is why we do like to highlight this part of the analysis, because ultimately past performance does not give any guarantees. Now, we also have to mention here the insider movement. Ownership itself sits at 11%, which is fairly high, and we do note just under $7 billion worth of sales over the last year, with $1.22 billion just being in the more recent quarter. Now, when we take a look, in fact, what we can see here is that the CEO did sell around 21,000 shares on the 21st of August. That netted him around $3.8 million. And what we always say, insider selling, it isn't a bearish signal. Management sell for many reasons, personal or financial, and one thing we can in fact see, Jeff Bezos himself has been selling quite a significant number of shares every time the share price does hit $200. In fact, the last time that hit, he sold around $53 million worth. Again, this is just for transparency, as we do want to show you, but ultimately we don't believe it should have any impact on your own investment decision. We then like to do the same for institutional ownership that sits around 72%. We see around $23 billion worth of sales by these institutions over the last year, but we see a lot more buying over the same time period, and in fact in the more recent quarter we do see double the amount of buys as sales, and you can pretty much see that constant theme over the longer term. Now remember, institutions, investors, regardless, insiders, always do your own due diligence. This is just one incorporation of our overall thesis. Now, in terms of free cash flow, as we mentioned, we do want to see this increase over the longer term. We do notice this has been very low, in fact negative in 21-22. But over the longer term, it has been increasing. It did rebound very strongly in 2023, and the expectation over the next 12 months is very strong growth. As we mentioned though, we do believe they will be able to continue this moving forwards with the acceleration in some of their top line revenue streams, the investments they've already done into the robotics, the automation in their warehouses, as well as now the investment they have put in to those AI chips. The next thing we want to point out is the sales growth. Now this has been pretty much double digit every single year, 12% in 2023, and as we saw on the projections in 2024 for the full year, they're expecting around 11 to 12% again, so this strong sales momentum is expected to continue. The ROIC, we do always want to see consistency around 10% as a minimum. Whilst we don't get that, it has rebounded nicely at 10% from the lows of 2022, and on a trailing 12-month basis of 14%. Again, that is nice to see. Hopefully they can continue that upwards momentum. And then we get to the margins. Now we talked about how their margins have been historically very, very low. Granted, it has been accelerating over the last 10 years, 9% on a trailing 12-month basis, nice increase from the previous year, but here what we want to see is a minimum 12%, so something we will keep our eye on, especially as we said, some of the ways they are looking to increase that margin, but just something we do want to flag. Free cash flow though, minimum 5%, which is what we have seen over the majority of the last 10 years, 8% on that trailing 12 month. Now the final metric that we want to point out is that net debt to EBITDA, and these numbers are the number of years it would take the company to pay off all of their debt net of cash on hand. Below 3 ideally, remember this correlates to the balance sheet strength, 0.61 in 23, 0.43 over the next 12 months. That does show us that this company has a very strong balance sheet and no real worries whatsoever in terms of that at the moment. We also want to let you know we have released our latest free weekly article. If you want access to this or any others, you can click on the pinned comment below, start reading straight away, and you can also grab our 25 undervalued stocks for the month of September for your consideration, where we also talk about those that sit within our own portfolio. On top of that, we have released a spreadsheet with the 22 dividend stocks with the most upside as well. So again, be sure to click on that pinned comment below and start reading straight away. Now let's jump into the valuation, and as always, if you do enjoy the content, value is being provided, smash that like button, hit that subscribe and bell button so you are continually notified. Now our value of $226 is purely based on the DCF model. Now how we got to this value, effectively we have the free cash flow year on year, we have the growth rate, and as we can see, negative 3%, again it has skewed on a year on year basis. And what we've looked at is a 20% rate moving forwards. We have a low, medium and high. Now based on the medium of 20% and a discount rate of 8%, we have the present value of future free cash flow and terminal value. We add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and then we get that 226, which ultimately gives us 22% upside. Now these numbers are fairly subjective, so you can grab a copy by clicking on the pinned comment below, running through your own numbers, whether it's for Amazon or any other company that you do desire. For full transparency though, for those that do believe it should be lower, well at 15% it would be a $159 price, and we can see that is downside of 15%. For those that believe it should be a lot higher, well at the 25%, as we can see, $319, indicating 71% upside. Now we will take through the medium rate to the conclusion at that 20% point, and what we always like to do on this channel is add a margin of safety. Now we start off with 10% and execute on that if we believe it meets the 3 golden criteria: wide moat, strong financial metrics, good forward looking data. If you believe that in today's episode we'll buy at $204, then we keep going till it's near the current trading price. And we can see in today's episode, it isn't at the 20% MOS just yet, but we note up to around $192, we do see 15% margin of safety, which is very strong for a company that we do like. We have run through this briefly today, but as always, do give us your thoughts below. Now, in terms of Wall Street, their price target of 223, pretty much thereabouts in terms of our own intrinsic value. They see 20% upside over the next year, and as we already said at the beginning of the episode, they have this company as a strong buy. As always though, do give us your thoughts in the comments below. Maybe this is one that you hold, maybe it's on your watch list, or for whatever reason it doesn't fit in your own investment thesis and portfolio. If you enjoyed the episode, well, smash that like button, hit that subscribe and bell button so you are notified of these videos as they drop. Don't forget to grab a copy of this model by clicking on the pinned comment below, signing up to the free weekly newsletter, as well as joining us in the Patreon where we do run through our weekly buys and sells. As always, have a great day and we'll see you all on the next one.